Hi there again. My name is Hammon, Vice President of Operations at Behring Co. We've gone through a lot today. What is EB-5? What's going on with EB-5? And we've learned about how incredibly successful EB-5 actually has been to date. It's been so successful that top markets like Vietnam, India, China are experiencing extreme retrogression, dealing with redeployment requirements, and we're learning that the program really isn't even equipped to deal with the issues of today. So you may be asking yourself, is EB-5 even worth it? What sort of EB-5 investments make sense? Did I miss the train? Well, let's jump into how the market looks at different investments. When you look at investments from a Wall Street perspective, this is generally how Wall Street's going to categorize risk. You have money markets, treasuries, cash, the lowest risk there. They're so safe that USCIS wouldn't even consider these an at-risk investment. We're here in the heart of Silicon Valley. Venture capital, that's really exciting, but it's unpredictable, it's risky. And I can probably think of 1,000 reasons why it's not going to work for EB-5. Blue chips, investment grade corporate bonds, these are great investments. The problem is tracking the job creation on these investments and keeping track so to make sure that we can actually get the green card. So that naturally leads us to one thing, and probably what you've seen in the market is real estate. It's simple, single investment types. Job creation's easy to track and record. You can guarantee completion. Real estate's a big category. There's actually a lot of different types of real estate, and they're not all the same. You have multifamily, industrial, office, retail, hotel. They all have different risk profiles. When we start to evaluate which one is the lowest risk, we determine pretty quickly that multifamily is the least risky place to invest. Industrial is number 2. Office is number 3. Retail is number 4. And one of the most common EB-5 projects you'll see in the market, hotel, comes in 5th place from a risk perspective. So what does that mean that's more risky? Well, diving into it a little bit further, you can actually start to subdivide risk into even more categories. You can look at risk by class of asset. Is it a class A or a class B? Is it in a tier 1 city like San Francisco, or is it in a tier 2 city like Portland? Is it in suburban or is it in urban? All of these factors impact the risk of the project. The one thing that we can tell from the graph, though, is that hotel is the most risky because it has higher capitalization rates, and multifamily, with the dots down low, are the least risky. When you look at EB-5 projects in the marketplace, what we typically see are urban infill locations, full-service hotels. And the same trend exists. Hotel is going to be more risky, and multifamily is less risky. Well, how are we evaluating risk? Capitalization rates. Capitalization rates are like interest rates. The higher the capitalization rate, the higher the interest rate is on that debt, which means it's more risky. Hotels have higher capitalization rates than multifamily, making them more risky assets. In fact, multifamily is the safest. It's 30% safer, has a 30% higher value than office, a 63% higher value than your typical full-service hotel in a central business district. And this is looking at properties that exist in the same market. What does that mean to you? We know it's high cap rates, or we know that low cap rates means lower risk, but what does it mean from an investment perspective? Well, there's a very simple relationship between the capitalization rate, your net operating income, how much money that building is making every single year, and the valuation of the property. If we assume that all 4 types of these properties in the same city are earning a net operating income of $1 million per year, what that means from a Wall Street perspective is that multifamily property with a 4.7% cap rate is going to have a valuation of $21.3 million. that's going to be 63% higher than the same hotel in the same location earning the same amount of money. That's a huge difference from a finance perspective. And this is the reason that when you look at the top conservative institutional investors in the market, your endowment funds, your pension funds, your REITs, this is the reason they are choosing residential instead of hotels. Why is residential more valuable or most valuable out of the asset types? Well, one, their operations are more stable. Occupancies are more stable. If you're an office building and you have Google as your tenant, you're a billionaire. If Google leaves, you're broke. Hotels, those are rented out one night at a time. They're very unstable. But if you have an apartment building with 452 units and one person vacates, you still have 451 units paying rent. This is why they're stable. Their income's more predictable. They're less sensitive. Residential is less sensitive to economic cycles. So if we're in a recession, you're not going to go and eat at that fancy restaurant. You're not going to be going to the 5-star hotel. But you still need a roof over your head, and that's not going to change no matter if the economy is good or bad. And finally, the kicker here, residential, it's not a discretionary decision. Office buildings should be freaking out about the WeWorks of the world. Hotels don't know what to do about Airbnb, but there's no solution for residential. In good times or bad times, you need a roof over your head. And this is the reason that residential, multifamily, time and time again, is considered less risky and the most valuable asset class out of this group. So going back to this slide, I assume many of you have looked at different EB-5 projects, and what you've probably seen is that 95% of the deals you look at are hotel, retail, and office. These are the most common EB-5 projects in the marketplace. Residential, when you do see it, is typically condominiums, for sale condominiums, which are going to be riskier than your for rent apartment buildings. Behring Company's focus is exclusively on multifamily for rent apartments. These are the types of projects that we offer to our EB-5 investors. So, like I said, you guys are combing through the internet, you probably feel it. Every project feels like hotel. It feels like a commercial project, another retail model. And they're all construction debt style loans, typically with very simple financial terms. $500,000 loan style investment, a 5-year term, guaranteed with securities and protections, intended to be short term. You know, in terms of thinking about the old EB-5 market before retrogression, these were intended to be short-term investments, and they were marketed to you as safe. You do see some preferred equity deals, but these are few and far in between. These are the least common of what you're seeing in the marketplace. Now, what's interesting is you see all of these projects grouped and clustered in the same category. But are they all the same? Is a hotel, like a condominium, like an office building? No, they're not. It's not a one-size-fits-all, but historically what EB-5 has done is tried to cram all its investors into the same projects offering the same terms, and those projects had vastly disparate risks. Behring has entered the market, and we offer investors choice. We have a debt-style investment for those investors that want max protection. We have preferred equity for an investor that wants to earn a little income. We have common equity with our BRC Legacy Fund for investors that want to be an equity partner. We don't believe that all investors are alike or should be crammed into the same bucket. Historically, one of the factors that has been impacting EB-5 investors' returns is the EB-5 discount. Now, what this really is when you take into consideration raising money for EB-5, there's different factors implicating it than if you were to go and raise money in Wall Street traditionally. For one, there's significant barriers. It's very expensive. It takes a lot of time to even become a regional center so you can do EB-5. Projects take a long time to even get approved. There's huge costs just to even launch an EB-5 project before the project even starts. And finally, you go through all this trouble and you do all this marketing, and you may not even find a single investor that wants to do that deal in today's market. So there's a lot of marketing costs and risk with doing an EB-5 project. This has historically caused EB-5 money to be discounted relative to other Wall Street money in the market. So going back to our slide, we know that the profits have been low historically. Well, when you start to really dig into the numbers as an EB-5 investor, you factor in things like USCIS fees. I have to pay an immigration attorney, one of the folks sitting over here. I need to pay the regional center fee. You factor in all these things. What we've actually found, and what you'll see, is that it's a net negative cash flow for the investor. What you're typically seeing is maybe $85,000 negative cash flow for your typical debt style deal. It's not until you start getting into preferred equity that you start to see higher returns and a net positive cash flow. So the preferred equity, the common equity deals, these deals are going to give you actually positive net cash flow on your investment in addition to your returns. Now, the net negative cash flow, the low returns, this was okay in the old EB-5 when there wasn't retrogression, when you didn't have to wait in long lines. But in today's environment, where you have more investors facing retrogression, where it's not a 5-year investment, it's an 8-year investment, or if you're Chinese, it's a 16-year investment, the low return deals that are generating net cash flow might not work for everybody. Now, there's certainly going to be investors that it will work for, but it's not going to work for everybody. So we've seen a shift in EB-5 from a short-term focus to long-term focus. What's the difference as an EB-5 investor between short-term and long-term? Well, short-term, it's today's market. It's very predictable. You have a pretty good sense of what it's going to be tomorrow. You're less likely to be redeployed to another project. Like Tom talked about from Baker Tilly in terms of with retrogression, there's a higher probability of redeployment. In short term, you didn't have to face those decisions as an EB-5 investor. Your short-term investment is more predictable, but you do have a forced exit point, meaning that in 5 years at the end of the deal, you're getting pushed out regardless. You don't have any decision over that. You're just out of the investment. So if it's a down economy, you're out in a down economy. Long term, yes, it's a little bit less visible because it's longer term, but it's inflation fighting, and you have a better chance for appreciation over that term. When you look at historical returns for apartment REITs, looking since the early 2000s, yes, there are some short-term gyrations in terms of up and down risk that occurs, but the big story is firm. Over the life of these investments, there's only one direction of the value of these investments, it's up. Long-term also allows you to ride out downturns, meaning you don't need to sell during an economic downturn. You can wait another year or two when the economy bounces back, and that way you get the profit you were always looking for in the deal. You have a better opportunity to maximize returns because you have that flexibility and when you exit the investment. Long-term is patient money, but in today's environment, when you have some investors that are facing retrogression, long-term is really your only choice. And the question you have to ask yourself is, if I'm going to be in it for the long term, what sorts of investments are going to meet my goals? Yes, I want a green card, but what sorts of investments are going to meet my goals if I have to be in a 10-year investment? The decision-making process is a little bit more complex than what it used to be. So in trying to evaluate how you make money, how you evaluate risk on a real estate deal, let's look at an example return structure, and you'll see variation to this. Senior debt, it's going to be first in line. It typically will make up anywhere from 50 to 60% of the cost to build. Then you're going to see mezzanine debt and preferred equity. Now, you may not see both of these in a deal. You may see one or the other. But in terms of order of operation, mezzanine debt's going to be repaid second. Preferred equity will be repaid third. Equity is in the last position. And then, of course, the reason we're actually doing this investment, the reason we're building this building, is for all the profit on top. So digging into it more, as you can imagine, senior debt is the lowest risk. It's considered short-term. It's first to get paid back, and it's secured by the building. Mezzanine debt, it's still considered short-term. It's in second position, and most often you're going to see it secured by the equity in the equity holders of the project. Preferred equity, it's third in line, but it comes with preferred returns. And typically what you'll see is these returns are going to be accrued over 5 years and paid out at the end of those 5-year term. And finally, equity. It's the longest term hold, but it comes with all the profits on the building. There's a longer holding period, a little bit more risk, but you reap all the reward, and that's the real deal. That's when you're starting to think long-term investments, equity is the place to be. So we've evaluated the market, the different types of investments. We've talked a little bit about the most typical project that you're going to see today. These are the most typical terms that you're going to see in today's investments. High upfront fees, no diversification, no liquidity, no flexibility, low returns, high opportunity costs. And you think about if I'm going to be stuck in an investment for 5 to 10 years, the opportunity cost is exacerbated with retrogression. Here at Behring, we talked to 10,000 investors over the last couple of years. And we hear about what investors want. And we keep hearing the same things over and over. And we basically have developed what is the wish list that we keep hearing investors asking. Can't I just be treated like a normal investor? Can I minimize those upfront costs? Can I make my investment in stages? Can I have greater flexibility and liquidity in my investment? Can I diversify my investment? Can I choose between different investment strategies? And the last one, can I build wealth with my investment while also getting a green card? Here at Behring, we think that you can. And we're going to take a little break here, have some food and some drink, but when we come back, Colin's going to talk to you about exactly how we think you can achieve these goals. Thank you.